ClearPath Business Advisors presents the Healthy Sellable Business Podcast, a podcast where we provide actionable advice, real-world insights, and expert strategies for business owners who want to create a healthy, sellable business, whether they plan to sell or not. Don't forget to follow us or subscribe to stay up to date. In this podcast, I am joined by my business partner, Pat Wilkie, and ClearPath's founder, Chris Crawford, where we dive into M&A transactions. Hi, everyone. Thanks for joining us today, and welcome to the Healthy Sellable Business Podcast, where we provide actionable advice, real-world insights, and expert strategies for business owners who want to create a healthy, sellable business, whether they plan to sell or not. Whether you're thinking about scaling, preparing for a sale, or building a succession plan, we've got you covered. Today, we're thrilled to kick off our very first episode with a very special guest, Chris Crawford, the founder of ClearPath Business Advisors. Chris recently achieved what so many of our clients dream of, selling his business successfully and transitioning it into the hands of his new owners and longtime partners, Pat, who's joining us today, Patrick Borman, and myself, Kristianna. Welcome, Chris.
Thank you. It's awesome to be here.
Awesome. And as I said, Pat and myself are still a part of ClearPath Business Advisors. So today we're excited to dive in. Chris started ClearPath 25 years ago in 2000 and built ClearPath from the ground up to what it is today. Chris, what inspired you to start the firm in the first place, and how did you shape its mission and values?
Well, I'll get into that in just a second, but to sit here today in 2025 and think 25 years ago, there's no way when I started I planned on building a healthy, sellable business and ultimately selling it. So it's just such a fulfillment to see that happen and to see it, the business continue in good hands like yourselves. So thank you for this opportunity. I would say that when I started the company, I had a vision. I had a big picture vision, and that was that I was really tired of working for corporations that had hidden agendas and too often decisions based on greed, personal greed. People seeing how much money they could put in their wallet. There was a lot of secret meetings in the corners of offices, and I just got tired of being a part of that. So I wanted to create a business that literally had no hidden agendas, that everything was on the table, that we would put together a team of people that had various levels of expertise that complemented each other, and that team could then provide services to clients to help their businesses grow and be successful. Over time, that became much more M&A focused. Initially, it was not. It was more financially focused. About 4 years in, we added M&A, which in hindsight, I should have done that from the beginning because that became our most successful business segment. And I know we'll get into this later, not as an end to itself. M&A advisory services that we offered were not an end in and of itself. They were more a byproduct of doing other things first to get the client ready and to make sure that they actually really wanted to sell. Some clients just want to build a healthy, sellable business and keep it and maybe back out of it. And so we weren't focused exclusively on selling, but that did bring a whole nother perspective. And it really tapped into a marketplace need because that's an area of business that most business owners don't know much about. And they're very susceptible to others who might want to take advantage of them. So M&A became a focus pretty early on, but there were a lot of other steps along the way. I remember shifting to an on-site business model as opposed to remote. That was a critical move. We did that in late 2007, being more balanced in terms of our business offering. I know we'll get into that as well, not being so concentrated on certain things. Really having a focus on our internal team and core values. We really want to honor our team inside and out, so our employees as well as our clients, and truly taking a personal approach, a relational approach to business as opposed to a transactional. was another early on area of emphasis for us. So I think it started out with, some big picture ideas to do the right thing for good people. But I must say, I didn't have a big plan. I didn't have the details. And so at the beginning, it was hard. The first 4 years were actually quite hard. In hindsight, I didn't have a clear path to talk to. I had to figure it out myself with my team, and Patrick Borman was part of that team early on. But it took about 4 years to figure it out. And then once we did, it's been pretty good ever since.
Well, and you talked about, that approach of making ClearPath successful. And I know you were operating more in the day-to-day, but as you were approaching, thinking about the exit for yourself in the business, what were the types of things that you were doing, to get the company ready for a sale or to plan your exit strategy?
Well, we had to, for sure, make it not dependent on me. That was critical. That's critical for any business owner. One of the biggest obstacles for business owners of small, medium-sized businesses is, can the business function when you're not there? And how well does the brand suffer? And how not just providing services, but building demand for your services and creating a pipeline of opportunities so that the company can continue to generate revenue while providing, valuable services. And the idea that we believe the business has to provide specialized expertise. You can't be all things to all people and just throw a spaghetti pot full of noodles against the wall and hope they want to buy some of it. You really have to provide a value-added service. And one of the things we did early on was we always had the mindset of providing services that did not require the client to hire us again. We wanted them to hire us again, but it wasn't required as part of the deliverable we gave them for whatever they hired us for. We wanted it to be sufficient on a standalone basis. They got value for what they paid for. And then if they wanted to hire us again for something else, obviously we would be thrilled. And I know this isn't actually your question, but I just like to say it because one of the things I was always most proud of is the percentage of clients that hired us more than once. And it was 93%. When I left, I think it's 96% now. So you guys are doing a good job. Back to your question. The key is really making the business sustainable and viable without the owners being there. And it's really sometimes very hard. I talked to a business owner the other day, and it was two people running a business, one location, very successful, but could they replicate it and not be there every day? And they weren't so sure. So scalability, you can't sell a business that's not scalable. That's not appealing to a buyer. Mm-hmm. Because they're paying good money to acquire a business. They have to believe they can turn it into more than it is today. And so putting the pieces in motion to create a business like that, that's not dependent, that is scalable, that has diversity of customers and service offerings, which can allow you to pivot when market conditions require that. All those things really make a business sellable. And I was living that mantra, create a healthy, sellable business, whether you plan to sell or not, is really a valuable perspective for any business owner. And certainly I tried to adopt that.
Chris, I'm curious, when we think about the different clients we've worked with and ones who have created something that can stand on its own without them versus the ones who sometimes perpetually seem to be struggling with that. What do you think are some of the attributes that separate those two, the business owner who is successfully creating a business that can exist without them, more or less, and the ones who just they can't quite seem to make progress on that front year in, year out? We hear from them after we've worked with them, and we're hearing the same problems as last time that they're still working through about, I'm always working in the business. I can never work on the business.
Yeah, it's a tough dynamic, Pat, for any business owner to get out of the firefight of day to day and focus on the strategic side of the business. And that's when you hear that, that phrase, focus on the business, not in the business. What they're talking about is pulling yourself up above and seeing it from a strategic point of view, creating a vision, and then creating a plan to execute that vision to make the business stronger, better, bigger, whatever the goal is. And if you're in the day-to-day and you don't have any time for strategy and time to execute that strategy, you're never going to grow beyond what you are unless you get lucky. But you could also get unlucky and have the business collapse if you're in the wrong market at the wrong time. So I think, one of the early things we did, we joined a CEO advisory group, the Alliance of CEOs, in 2007, I think we did. And then we joined Vistage International shortly thereafter. And what that did is it gave us, both Patrick and I joined, and it gave us advisors, people that were advising us. And it gave us access to education and speakers and learning and seeing how other businesses performed. Those were some of the most valuable experiences we had to waken our mind to the need to be strategic, because we can all get caught up in the day-to-day. I mean, there's always not only the to-do list that you go into the day with, but the fires that start the second you walk in the door, and you could always never get to your priorities if you don't resist. So by forcing strategy to be a part of your business model and execution of that strategy, it makes a business so much better and more capable of seeing what's coming before it gets there. It's a really critical part of any business success.
So you think it's kind of setting aside the time, having a plan, and then I think the other key takeaway I just got is that third party who, because I think Vistage in some ways kept you guys accountable to always be thinking about these things and not, it's an appointment, it's on your calendar, you have to go do it. You're in the meeting and you can't be distracted by those fires when you're in the Vistage session, right? Yeah,
good point. You're off-site. You have to, you have the meeting coming up. You don't want to be the guy that shows up or the woman that shows up unprepared,
And do the homework.
So you got to think, even a 1 day of strategy a month makes a world of difference. And the more you do it, the more you realize the value that comes from doing it. And then you can set up your business to allow for, particularly at the senior executive level, you can bring in people to do things that you are doing now. You have to be able to delegate. You have to be able to be confident in your team and have systems of checking, trust but verify, holding people accountable. That's super critical. But you have to be able to let go of certain things. A lot of business owners in small businesses feel like they got to do everything because they're the only ones. And that's so not true. People are so talented and smart. And if you give them room to perform and you allow them the opportunity to have a voice, you're going to get ideas that you never had on your own. And so you're going to see the business thrive, but you're also going to create space, time for the senior people to participate in strategy sessions and then bring the rest of the team into those this decided strategy so that they can participate, fine-tune it, and then participate in the execution of it. And I know for ClearPath, and I know you two and Patrick were instrumental in that, as well as other people, you lived that. And even in your early days where you didn't have as much business experience as you have now, the education you got by participating in those sessions empowered you to grow faster and to be much more capable of taking on senior assignments and being part of now ownership, even if, in a certain way you weren't ready for it, maybe in some textbook sense, but you were capable. And it's not just you guys. I mean, you guys taught me in many ways the capability younger people have, and I mean younger than me, and the talent you bring to a team and to a company, if just given the opportunity. And remember, with Kristianna, when you started, and I was including you in every meeting and having you sit and mentor, or I would mentor you and you would shadow me. And the only thing I asked you to do is pay attention and ask questions, share your thoughts. And, that took some effort because it's a lot of stuff to kind of navigate through and make sense of. But over time, it starts to connect the dots. And then your ability to contribute new thought or challenge my thinking made me a better leader. So it's so important to bring people into the senior level part of the company, to then allow the owners or the most senior executives time to develop and participate in strategy, and then to filter that down into the organization. So it's really a team effort.
Yeah, and I do want to touch on, Chris, I was going to ask you to emphasize, the people importance when it comes to building your business. And I really love all those things that you shared. And just to emphasize, I remember one of the first clients I got involved with, Mommy's Bliss, is I truly did start out new. I got the opportunity to sit in meetings with the CEO, the management team, but truly at that point was just absorbing, listening, giving my feedback on the side. And through all of that, I continued to gain confidence and grow. And we were able to take that client all the way from our beginning role as, a CFO client through an M&A transaction. And I'd say two parts when we're talking about this, the benefit, the client saw that 100%. I was able to help work with them. Chris was as well, but to think that I had just started with ClearPath and I was able to see them all the way through that and play a pretty significant role. But then ClearPath's benefit of that is allowing me to participate in these meetings and allowing me to have conversations with, people in businesses I never thought I'd get to sit in a room with. That now with ClearPath, not just the confidence, but the ability and just being able to do those things now that maybe someone else on the same path, but with a different company wouldn't be able to do because of the mentorship and the ability to participate.
No doubt. And think about the acceleration of your learning curve that occurred because you were allowed to participate and not just sit there, but to engage in conversation, to offer your thoughts, whether it was with me privately or in a public setting with the client. And over time, you did that more and more. But the key was by giving you, a seat at the table, as we called it, you were able to not only contribute to the client and to ClearPath, but to your own learning curve. And that just, to me, to think that you two in particular, just being younger and having a lot of your career be at ClearPath, relatively speaking, the things you've learned over time by being at the table and being able to take on assignments and take on significant work yourselves without being parceled out the little pieces that maybe you might get at another firm until you're ready. My view is you're much more capable, you and others in the, well, I want to speak generationally, because I think the capabilities of the generation that you guys are in is so powerful. The ability to multitask and connect the dots and really piece things together without the experience that normally would be considered required from my generation. So you proved me, you opened my eyes, and I think that allowed ClearPath to accelerate its growth tremendously.
Yeah, and we emphasize so much on the people, and then we've touched a little bit on our clients and other factors that have just been so important to, the successful transition of a business. ClearPath, one of our areas we focus on is valuations, and over the years we've been able to do them for owners' personal benefits, and all the way to the point now where we can do certified valuations. We've talked about the factors of, you personally being able to make sure that the business wasn't completely dependent on you. What are some of the other valuation factors that you took into consideration when you were exiting ClearPath? And, even describe it over the years. We've had talks, before 2020, before COVID, and then after, and you obviously know your valuation went all over with those. So what were the key things in your mind that were kind of playing, big parts of that valuation, and what mattered most to you?
Well, valuation's a critical piece of the puzzle for a business owner who, whether they want to sell or not, they just want to create a healthy, sellable business. And I mean, maybe we should back up. What does it mean? Why do we say that? Healthy, sellable business.
Yeah.
It means a company that's strong and successful and stable, in my mind, growing, that the risks are manageable. The things that could take a company down are, there's an awareness of those things and a intentional management of those factors. So you have healthy, sellable. A sellable company is, by definition, in the eyes of a third party. So we can sit here all day and talk about how sellable our company is, but if no one wants to buy it, it's not sellable. Yeah. It's just not. So you can go online and Google, various metrics of value and multiples of EBITDA or revenue and get all excited if you don't know anything about it. But I guarantee you, and you guys know this better than I do, those generic metrics mean nothing to a specific business. You have to look at the market you're in and the very specific elements of your company that could improve or derail your ability to sell it. And some examples, like we touched on, or we haven't touched on this yet, when we first started doing M&A, that was in 2004, about 4 years after we started the company. By 2007 into 2008, it was just taking off, and we were going after it. And we had, at one point, we had more than 10 M&A transactions at the same time that we were working on behalf of our client, which was a private equity firm that was doing a roll-up strategy. And it was phenomenal business. And then along come the mortgage crisis. I got the phone call Thanksgiving break 2008 from our client. His name's Dennis. And he said, "Hey, Chris, I don't know what to tell you, but the banks just shut off our funding because the mortgage crisis was making the whole financial world upside down. And therefore, Chris, I'm sorry to say, but all of our transactions are immediately on hold. You can't do any more work. You're not going to get paid." That's the message. I'm like, oh my goodness, right?
Happy
we were
Thanksgiving.
60% of our business was with Dennis's company, 60%. And probably 80% was M&A.
Mm-hmm.
So thankfully for us, the same crisis that shut down the financing world from the banking side created pressure. Financial leadership was greatly in demand. Companies called us immediately saying, "We don't know what to do right now." And thankfully, our backgrounds were heavily in senior financial leadership and M&A. We had just gotten caught in the wave of M&A demand and kind of shed the financial stuff because the M&A was more pressing, more lucrative, very exciting. But If we didn't have that financial background to fall back on and to pivot on a dime, we would have been in big trouble. As it was, I mean, I don't know how it happened, but we didn't miss a beat. We replaced all the M&A revenue with fractional CFO services, like within the next month. And we learned a hard lesson, and we were very lucky. One of the critical factors to a healthy sellable business, to having a good valuation, is lack of concentration, lack of dependence on people or clients or business segments. We were, remember, 60% on one client, 80% on one business segment, no more. So we shifted and we created this balanced system. I mean, thankfully, we were also on site by then. So we were working face to face with clients. Remember, relational is so much better than transactional. If you're working with people that you know and you like and you trust, and that's our whole business model, we got to earn your trust every single time. Every project, we start from zero. And yeah, we believe we do earn your trust, and 93% hiring us more than once proves that. But we feel we got to show it and earn it. So if you work on building trust, if you work on being present with the client face to face enough so that they look at you as a person and not just an invoice, and then balance your business offering between, ours is even more balanced now, but at the time, fractional CFO and M&A advisory, which are very complementary. We can get into that later as well, but that was a key thing. A lesson learned, but also a key element of what makes a company, ClearPath in particular, valuable or not, sellable or not. And you could extrapolate from that. If the business, I said earlier, if the business was too dependent on me, it's not sellable. You know, if you pull me out and the business can't perform or can't generate new business, then no one's going to buy it. So over time, remember I mentioned that Patrick and I both participated in Vistage. You know, that was an investment on our part to say, look, you know, we're going to get value out of it, and that's longer term value. But being strategic and having two people out in the marketplace learning what drives businesses, what drives the value of businesses, and making connections and networking and meeting people, tremendously valuable. You got to be out there, and it can't be all formulaic. It can't be all on one person. Business development in a relational sense for us was critical. And I know, the statistic of how long clients work with ClearPath, I don't know exactly that, but it's a long time. It's, if you go from start of relationship to end of relationship and identify those companies where the end was they sold their business. So it's not like an end because they didn't need us anymore. It's an end because they succeeded. They crossed the finish line. And that, for us, that's the ultimate happy time, right? When you help a client achieve that goal. But I would imagine our statistic on client tenure is very, very high. Again, because we want to keep helping them. We want to keep proving ourselves, keep earning their trust, driving their business, meeting their goals. Because when you look at, what makes a business healthy, sellable, and valuable, you have things that drive value and things that take away from value. And you got to look at that, and you got to keep track of it, and you got to measure it and measure it over time. And just even that exercise of identifying the areas that make a company valuable and sellable and the factors that don't, and keeping track and measuring them over time, just that practice alone will create awareness of what you need to do. Much less if you get specific and say, all right, if I'm going to minimize the dependency on me, what do I need to do? I need to hire people that can do senior work. And yeah, that's an investment. But what's the flip side? It creates a sellable business versus maybe not. We got a client, Kristianna and I work on, have for many years. It's one of my longest clients. I still help a little bit there. And it took them a long time to realize they need to deepen their bench, if you want to look at it that way, deepen the talent pool of managers and directors and vice presidents, not lower level. We're talking senior people. You got to empower your team to be able to make decisions, even if you're not there. And it's hard because it costs money, and you got to train them and onboard them, and it's pain. But long term, that's another critical piece of valuation. I think we haven't talked about core values yet, but I think that's been, if not, it's one of the most important things that created a healthy sellable business for ClearPath, because we defined core values things we would live by, and we applied them inside and out. So you got a team of people working together that knows that we stand for something. They know what our vision is. They know what we're trying to achieve, and they know how we treat each other and how we treat our clients. And then you have clients that feel that and speak to that, and we get testimonials, and they say things that show that ClearPath is a company that we trust, that we like, we have a relationship with. They've helped us. They look out for us, not just themselves. It's those kind of things. I know for each one of us, every employee at ClearPath, you feel good when you hear that. And if you ever hear the opposite, you feel bad. Like, we screwed up. We did something wrong. Let's see if we can fix it. It doesn't happen often, but it happens. You take your eye off the ball. So you got to have a good set of core values that mean something, and that your internal team, your employees, and your clients can identify with.
Chris, I'm curious. Almost every business has core values. We new client all the time. We show up, and somewhere on the website is a list.
Mm-hmm.
Integrity, feel goodness, whatever the list is. Big corporations have them too, but I think those values for us, like you said, they really do. Our clients feel that, and I think the way our clients feel us living those values it's been good for our business. So what do you think it is that separates the businesses where the core values are they're on the website, and half the employees probably couldn't even tell you what they are, and the ones who could name them don't really live them, and it doesn't actually influence the business in a positive way. They're just there, versus the other companies, and I think I would consider us one of those companies where they are really felt and lived by the customers and the vendors and the employees, and by doing that, there's a positive impact to the business. Is it a leadership thing? What do you think?
Well, you made me think, Pat, that when ClearPath really got into its establishing core values and culture, that was when we were working with Mommy's Bliss, and Kristianna and I were going out to Mommy's Bliss. I think it was once a week or once every other week for a long time, for like 4 years. Mm-hmm. Before we got into the M&A side. We were their fractional CFO, and I was their fractional CFO, and Kristianna was assisting me in that effort. And so we saw, and again, we were on site. So we would witness the CEO, her name's Yasmin Kadarali, and she took over the business from her mom. So her mom and dad, her mom really came up with the idea, and her dad and mom put a business plan together. And they had been in business for over 10 years. And it was like flat, steady, but flat. And Yasmin worked there a little bit, and she came in, and she took over the role of CEO. And I met her at the Alliance of CEOs. That's where I met her. So she was already, by definition, if you join a Vistage or the Alliance, you're a CEO that is receptive to help. A business owner or a CEO who's receptive to help. That's so fundamental. Back to valuation and anything having to do with creating a healthy, sellable business. If you're not receptive to help or another opinion, right, you're stuck. So Yasmin was receptive to help. I was receptive to help. I'm a member of the Alliance and Vistage too. So So we connected there. We started the CFO fractional role at Mommy's Bliss, working directly for Yasmin. And because we were there enough, we were able to witness how she created culture. And she spent so much time and energy bonding with her team, having them bond with each other, having events, talking about their core values, sharing updates with the team on how the business is going. Every quarter, there were formal company-wide meetings. They'd go off-site and have a picnic. Once a year, they'd take every single employee off-site for a 3-day retreat, and they even included me on several of those. I was blown away. And that takes a lot of effort and a lot of work and investment. But the team was so tight that when market conditions were hard and they had to work really hard and they had to get orders out by the end of the month or whatever the tension was, everybody dove in. Everybody helped. And it's like, all right. So I realized at that time that ClearPath's culture, because we were on site with our clients so much, we really identified with our clients almost more than we identified with ClearPath, because I had not made the effort to create a ClearPath culture. So I started, number one, I realized the importance. And number two, I didn't want anything canned. I didn't want to just pick words off a page that sound good. So very thoughtful. I had a lot of training in this by then. And so when we picked the initially 3 core values and then ultimately a 4th, the 3 were integration, convergence, and service. And the 4th was everyone. And real quick, there's a story behind each one, but I'll give you the short version. But I'll also say that these words, integration and convergence, and everyone, no one would know what they mean. I mean, service, you could guess, but integration and convergence, nobody's going to know what that means if I just said it. So it gave me the opportunity to explain it. Like if somebody asked what our core values were and I reel them off, if they're at all interested, they tell me more because they don't know what it means. Integration means we're the same all the time. So you're not going to run into a different version of Patrick Borman if you run into him at a baseball game, a grocery store, or a business meeting. Mm-hmm. Patrick is Patrick. No hidden agendas, no, pretenses. He's authentic. That's the goal. Be authentic all the time. Convergence is when you take your skills, things you're really good at, combined with passion and purpose. If you do that, you are operating at your highest level of performance. And it's your highest level of fulfillment, personally. So if you're doing what you're really good at with passion and purpose, you are hitting it out of the park yourself, and your clients see it. You're doing well. You're producing value. We want to be at convergence as much as possible as a team, as a company, first, and then as individuals second. That doesn't mean we can be there all the time. That doesn't mean, I don't have to do data entry or, clean, mop the floor sometimes. Of course I do. And take out the trash, no problem. But most of the time, right, we want to be at convergence. Service is a bit more self-explanatory. We want to serve our clients. We want to do it right. And that's from their point of view, not ours. What do they need? What's best for them from their point of view? And then lastly, everyone, that was the one I alluded to before, give everyone a seat at the table. Give them the opportunity to participate, with the only requirement be that they participate. They pay attention, they show up, and they share their questions and thoughts. So core values, very thoughtful. They shouldn't just be canned. They should really mean something. And when they do, then they resonate. Because you can tell I care about those core values. I'm sure you can tell just by me talking about it. And I do, right? And then what else do we do? And you guys do this better than I did. You talk about them every month. And one of the best things, and I don't know if Patrick thought of it or maybe you guys did, but we started doing tell us a story. All right. Pick 3 of the employees this month. Tell us a story about how you lived out or how you witnessed this core value being lived out. And remember, I know you remember this, at first people were like a little shy, a little hesitant. And after a while they were like, no, I got something to say. Pick me, you know? They were excited. I'm like, that is so awesome. And you guys do that even more. You've expanded the core values and made them little, certainly more defined. I mean, the words are still there, but there's substance at another level of depth. And you sit and you talk about it as a group and you reinforce it. You're living it.
Every week. Yep.
Yeah. That's the key. You got to live it.
Well, and just to add to that really quickly with the living it is really embedding that in our recruiting process. So I feel like talking about our core values with people that we were trying to hire for ClearPath, it really kind of helped weed it out individuals based on their response, or did they come prepared, or what the interest that they showed too, right? So I think we always joke that somehow we end up with these really great people to work with, but it's not by chance. I think that not just skills matter when we hire these people. We're really vetting out who they are and how they relate to our core values as well.
Character, right?
Yeah.
We've all heard that. Character is the most important thing. You can't train character. You can train skills, but you can't train character. And we introduced this, the predictive index. I don't know if you want to talk about that, but through Vistage, Patrick and I learned about the predictive index, and ultimately ClearPath became certified, one of two Bay Area firms that are certified to actually provide a predictive index service to businesses.
Chris, what is predictive index? Just for people who don't know.
It's one of those assessments like Myers-Briggs or StrengthsFinders, but it's different in that it is very scientifically based. It's been so much validated that it is the only assessment tool that can be used legally for hiring decisions or not hiring. Like you could say, I'm not hiring you because your predictive index was off from what our requirements are. And you won't lose a discrimination suit based on that decision. So there's a lot of science, and the core of it is kind of an interesting background story. It came about, the government initially created this assessment tool during wartime to evaluate the personality type most appropriate for being a fighter pilot versus being a bomber pilot. And you can think, quick, rapid, maybe more aggressive versus, I know I'm going in a risky situation, but I'm staying the course, I'm okay. Yeah. So it's really good for differentiating between salespeople and sales managers and salespeople. Someone who's good at managing people is not necessarily the same as a good salesperson who's willing to go out there and hear the word no, 8 times in a row before they get to a yes. Some people just can't handle that. So really understanding the PI or predictive index, and it's good for accounting, it's good for leadership. It covers the gamut. And it's remarkably accurate. Yeah.
So I remember when you guys had me take it during the hiring process, and I thought, you take Myers-Briggs at some point in your life in college or something, and it's kind of squishy, and I'm a numbers guy, so I took it, and I remember thinking, like, I had zero confidence, and I thought, this is dumb that they're making me take it. Like, didn't have a great impression about, like, what kind of company makes you do, like, one of these, like a horoscope type thing. And then I got it back, and I was like, wow, that's really incredible. That's me, all right.
It's crazy accurate and in depth. It's like, how would they know that? How would they know that? Like, and how they know it is because they've given it to so many people that if you basically answer 50 questions in 2 different ways, and then they extrapolate what that means about you, and they've given it to so many people, they know that you answer these 50 questions like this way, they got a population of 10,000 other people that have answered that questions that way, and they can take a pretty good high probability guess as to how you're wired. And it's not so much. So what's the real value of the predictive index? Is not that you're trying to put people in buckets. It's just you're trying to understand how they're wired, how they make decisions, how they react in certain situations. Because at its core, we have to remember when we're talking to somebody else, we're not talking to ourselves. We're talking to somebody that's wired completely different than us. So if we want to engage and connect with that person and have a relationship, remember, we want to be relational with our clients. We want to help them. We got to understand how they're wired, how they think, and our employees the same. And so it's like, if I just keep that one thing in mind, when I'm talking to somebody else, I'm not talking to myself. It's like, all right, that's a great thing to keep in your head when you're having a conversation, particularly one that might have a little edge to it. So having a team of people that you really understand how they're wired helps in the hiring decision. And back to Kristianna's point, making good hiring decisions is not an accident. It's not luck.
Yeah.
I mean, a little bit,
but
some level you can improve those odds. And I can't tell you, I mean, in all our years at ClearPath, 25 years, I mean, I can probably think of 4 people that we actually terminated their employment for performance. Not very many.
Yeah, it's been rare.
Yeah.
So, we talk about all these things leading up to, the grand sale and M&A transaction. And like we've mentioned, you've personally experienced that. What would be your biggest advice for owners when they're thinking about their exit planning?
Well, the best example of that would be Man Packing, because they had a situation where there's a 3rd generation family business approaching a 4th generation. And that's something ClearPath is particularly suited to do. We've had so many multi-generational family business clients in our history. And I don't think that's an accident either. I think ClearPath has because we're so relational and because we take it personally and we're trying to represent our clients from their point of view and earn their trust and all the things that we've talked about, it's like, at some level, if there's a connection, and we certainly had that with Man Packing, they think we're on their side. They believe it, and we are. But for them to believe it is so awesome, right? And so here you have a multi-generational family business, Man Packing, approaching a 4th generation. They're like, that's going to make it really complicated. We're going to go from, I forget if it was like 15 owners to 45 owners.
Yeah.
Many of whom have no idea how to run a business.
Yeah.
They're like, we have to sell. And Man Packing, I mean, they were a very large company, over 600 million in sales. They had their choice of M&A advisors, for sure. And they hired us. They hired ClearPath. And at the time, I mean, maybe we had 13 people. For sure, we didn't have more than that. We had one office in Pleasanton, and we were competing against firms that had offices throughout the world, London, Paris, San Francisco, New York. And what the CEO, Lori Koster, told me, I said, look, like, why did you hire me? Why did you hire ClearPath? And she said, because you treat us like family. You care. And she says, I'm talking to all these other M&A advisors, and their eyes are like bulging with dollar signs, And we want to make good money on our sale of our business, but there's other factors, and there's always other factors, Pat, always. I can't tell you, we've done over 185 M&A transactions now between ClearPath and each person working there, which is a boatload of experience. I guarantee you, anybody watching this, I challenge you to tell me how many people you know that have that much M&A experience? Because I don't think there's hardly any. And when you work in that environment, the one thing that is an absolute truth is that when you're selling your own company, it's often, almost always, the biggest business financial transaction of your life. It's life-altering personally, because you've got your heart and soul in that business. Mm-hmm. You probably have people you care about that work there, or customers that are people that you care about. So yeah, you want to make as much money as you can, but you also have other factors at work. And for ClearPath, we're not trying to do anything other than get the client what they want, whether that's more cash or those intangible things. If they want the intangibles, that's totally fine for us. In fact, we've even talked business owners out of selling, where we would have made a success fee if they sold, but we talked them out of selling because that's really what they wanted, and they just didn't know how to articulate. So when we get to Man Packing, and she says, I'm picking you guys because you care. You care. And I think, that was such a powerful experience. But then the funny thing is, and this is a long way to get into your question, within, so what's the first step when you engage? It's all right, Lori, we got to get ready. What does that mean? We got to do some due diligence, like on your behalf, internal due diligence is what I called it, so that we can identify what an outsider would see. We got to look at it from an outsider's point of view before we just open everything up for examination and due diligence. We got to know what they're going to find, and then be prepared to speak to that, not to lie about it or hide it. Obviously not, to be open and transparent, but to speak to it coherently and with understanding. And to the extent something needs to be fixed, let's fix it. Or we just need to know more about it. How did this event happen? Let's explain it in the right way. So we need to do some due diligence. Then we need to do evaluation. And valuations the right way take understanding of the business, not just show me your P&L and your balance sheet. You're never going to get an accurate valuation if you don't dig in a little bit. So some of this internal due diligence reveals things that can impact value. So we need to know that, and we need to kind of get our bearings on valuation. Then we need to put a package of material together. We call it a confidential information memoranda, or a SIM, to present the business in a good light. And that creating a SIM can take months. It's like, this is your best foot forward. You're not going to rush out to market with some, vague understanding of what your business is. You need to very thoughtfully and thoroughly understand it and then present it in the best light. And there's all kind of market, data, product, service, financial, elements of value, all kind of factors that go into what's in a SIM. So the getting ready part, depending on the company, can take anywhere from 3 months to 9 months. Could take more if there's something you say, if we fix this thing that's not so good, we think you could get a higher valuation. The client might say, then let's fix it. I don't care if it takes an extra 6 months. I'd rather fix it. Other times they say, you know what? I just want to get out. I'm tired. I need to leave, or I have a personal situation going on. It's like, whatever you need to do, we just want our clients to have eyes wide open. So it takes, on average 3 to 9 months, say, to get ready. Well, with Lori, within, I don't know if it was 1 month, Kristianna, or 6 weeks after we said, let's get engaged, or they engaged us to be their advisor. She said, Campbell Soup is buying companies. Let's call. I said, Lori, we could call them if we were ready, but we're not ready. We're not ready. Right. You're not going to get your best offer if you're not ready. And if you call someone and say, I want to talk to you about potentially buying my company, the very first thing they're going to do is say, send me the SIM. Well, we don't have a SIM yet. Well, then why'd you call me? I mean, come on. So getting ready is a way of characterizing what you got to do first. And then beyond that, taking the company to market, depending on what we view as the best strategy. In Manpacking's case, we took it on a broad base. We shopped it around to probably 70 companies that we targeted through our own research, through our own networks, and through the client who knows some likely potential buyers. We did strategic buyers, financial buyers, and hybrids, which is a combination of both. More and more these days, private equity firms will have a business like yours in there somewhere, so they combine kind of a strategic and financial mindset, and then bring that to the table, and it's somewhat of a hybrid buyer. So you have to be ready for strategics, financial, and hybrid buyers, and you want to shop to each one because you want some of each in your population of prospects. And then you go through a process of winning those down and getting to a manageable number and getting some level of indications of interest and due diligence that they conduct, and meetings, and on and on and on. One thing I like to say, in case anybody listening doesn't know that, one of the great competitive advantages that ClearPath has, and why I think even though Lori at Manpacking hired us because we understood their business, we were like family in a way, or at least a personal relationship had developed. But the thing that really made it successful is that ClearPath, we have a very special, I don't know that it's unique, but it's rare combination of expertise that comes to bear in a M&A transaction very well. So having that CFO business experience from inside the company is critical. Then having done 185 plus M&A transactions, of which approximately 60% are sell side, meaning the company was selling, and 40% are buyers. So we know what buyers and sellers, how they think and what they're looking for. All of us, including you guys and certainly Patrick and myself, have lived through M&A transactions where we ourselves were a shareholder. And then you bring in, well, we also know enough about CPA type issues, taxes and GAAP accounting, critically important. That's the common language, GAAP accounting. If you don't know GAAP accounting, you're going to get twisted when you're talking to potential buyers. We also know enough about the law. We don't substitute for our clients in terms of a legal. We always want them to have an attorney on the engagement, but we can talk the talk and we understand the issues. And that allows the legal issues to be driven from a business perspective, as opposed to the legal issues taking a life of their own, which can not only be expensive, but it could derail a transaction unnecessarily.
Kill a deal. Yep.
Yeah. So we bring a lot of variety of experience together in a small team that works on an M&A transaction on behalf of our client. That is, like I said, if it's not, it's not that there's no other firms like that, but it's rare. And it's certainly rare in firms our size.
Yeah, I would definitely agree with that. I think when you think about companies that are, I'll say, down market from us, and I'll just say, more of a one man or woman shop business broker, somebody like that.
Yeah.
The things you just touched on, the getting into the legal issues and talking with the attorneys, really understanding GAAP accounting, and having been a CFO at multiple companies, they just don't bring any of that to the table. It's just, we're going to put together a little book, we'll shoot it off, we'll get some offers, and I hope it closes, because then I get my fee. That's it. And then at the upper level, you go into the larger firms, and it's what did you say? Roy Coster said it was like we all just had money bags in their eyes when they were pitching her on the deal.
She said it even more graphically, Pat. She said, I needed to go to the restroom and wash my hands after meeting with them.
Yeah. They're just too slick, and it's purely transactional, and they're very talented. They're very good, but you just know they're not going to go to bat and protect the owner or do what we've done many times and say, this is not the right deal for you. You should wait, or you should not sell, or you should pass, because those guys, they want to get paid.
Yeah. Yeah. And there's a couple examples where we actually were recommended to our client that they hire a different M&A firm than us.
Yeah, that's true. We do that. Yeah. Somebody
because
with
we felt that there was a specialized sense of expertise that that other firm could provide that we could not. And in both the examples I'm thinking of, the client still engaged us to help. We weren't driving the M&A transaction, but we were on their side helping, and we were kind of, in a way, validating what the other M&A firm said, because sometimes it's not real clear. I mean, this is an area of expertise that most business owners don't have. Smart as they are, they don't have that. So sometimes, and back to, we want to do what's best for our client, not what's best for us. If it makes the most sense to say, you know what, that firm's better for you, you should hire them. I think that speaks a lot back to our core values and our whole mantra of doing the right thing.
One of my favorite analogies that we've always kind of consistently come back to is just acting as the quarterback. Is there are all these different areas and we can really coordinate it all. And like we said, we're never going to try to act like we're experts in one area other than what we truly do know. But being the person can coordinate it, being the person that can digest it all and explain it to the CEO and the rest of the shareholders who are most of the time busy running the business. And, that's where, I was going to crack a little joke, but it is true is, even the transition of ClearPath, that transaction is, I can't even remember how many times we joked about not taking our own advice, of not having an outside advisor who was handling this stuff for us, because we're like trying to do the business and the day to day. But then this other thing that, as you mentioned earlier, is probably the biggest transaction you're ever going to do. Hopefully for us, we have a bigger one down the line, but we're trying to do that and the day to day, and having someone who is an advisor, to be taking care of that, I think is just so meaningful for someone to be able to get sleep at night. And one piece of that as well that I know we've said to our clients is, when we try to help them with other advisors, whether it's legal or CPA, and, sometimes fees are high, and we try to be like, oh, well, yeah, that's, they're a small business. Does that really make sense? And we've checked ourselves of just, this is the biggest transaction you're ever going to go through. These people know what they're doing, and you want them on your side. That it's just well worth it. And again, that peace of mind and sleep at night is so worth it as well, I think, too.
Yeah, no doubt. And one of the worst things that could happen during a transaction is if the business starts to suffer and perform poorly. And if the owners are contributing to poor performance because they're taking the eye off the ball, because they're obsessed and focused on the transaction and not their business, that's a disastrous scenario. And we know all too well, how long does a transaction take once the potential buyer is engaged? That can take 3 months would be the shortest I've ever seen. And that was driven by a very specific set of circumstances. Usually it's 9 to 12 months from the day the buyer prospect is engaged. They're not yet the exclusive buyer, maybe, but they're engaged, to the closing. And I guarantee you every month of those 6, 9 months, or even longer, potentially, every month they're saying, how's the business performing? Is it performing in line with what you said it would do? Every month. And if it stops doing that, either they get scared and walk away, or the valuation just starts going down. It's like there's no good out of that. So the business owners have to stay focused on running the business even more during the transaction, and allowing an advisor like ClearPath or whatever firm they choose to manage the transaction. It also makes our job so much easier when we can manage the transaction and not have the client try and jump in front of us.
When the business is growing, making profits as opposed to the business suddenly does that. Yeah. We've done that before. It's hard, but you can do it.
Yeah, it is hard. That's where the trust is so key. They got to trust, we got to earn that, but it's got to be there.
Yeah, so, after the transaction, the transition is such a big piece too. It's like, you have this change of ownership, and, we've seen it from all angles, whether it's a strategic or private equity, is things can just change so quickly. So, what are some of your advice around a transition? And then even speaking to ClearPath itself, I know we knew for an amount of time that this would be happening. So we got to have the benefit of a longer transition, but what are the key factors there of making sure that it's smooth?
What we try and do at ClearPath is build in integration planning into the cycle of before the closing of the transaction. So a few months, ideally, a couple months, 3 months. I mean, you can't do it too soon because it's it's got to be after due diligence is pretty close to being done and the legal documents are kind of framed together. So you really know the business is likely to close. You talk about business integration. And what does that mean? It's like, well, what are the first months, first year, the first 3 months, the first year look like? Who, if to the extent the buyer or to the extent the seller is staying somehow involved in the business, sometimes it's more of a merger than an outright sale, or it's not a 100% sale. It might be the previous owner might be retaining some percentage. Oftentimes if it's a private equity group, there's a 2-layer transaction they hope for. They sell some now, and then they keep a piece, and then they hope 3 or 5 years from now they sell it for even a greater multiple. And in that case, typically that owner is part of the management, if not the CEO of the business. Sometimes it's an outright sale, but there's still contingencies and factors that make the seller care very much what happens after closing. And so you want to go through the drill of, how is the business going to be run after closing? How are decisions made? What's the budget for year one? Is the buyer investing capital into the company to scale it up? What are their plans with respect to that? How are they financing the close? Are they layering debt on the business that now the company has to service the debt? Or are they putting in equity capital that doesn't require that service? Are there fees that the company will now have to pay to the buyer, particularly if it's a private equity group? The private equity group often, almost always, charges management fees. And they might have board member fees, and they might have all kind of fees. So what's the cash flow look like after closing? If there's a problem, how do we decide what to do? What's your plan with respect to the employees? Are you retaining them? Are you not retaining them? Some of them? How are we going to deal with that? So you talk about those things before it happens. And back to earlier in the conversation, the answers to some of those questions might be critically important to the seller. If our client's the seller, they might care very much how those questions are answered. So much they might say, I don't want to sell to a company that's going to do what you're about to do. But you got to flesh that out. And sometimes, Pat, you mentioned the business brokers, and that's kind of in our world, a derogatory term for a low-end M&A advisor. Main street broker is sometimes the term. They're just selling business as fast as they can. They're not investing time into making it a better sellable business. They just want to sell it. It's kind of like when you sell your house. They don't get paid until they sell the house. So a Main Street broker or business broker oftentimes doesn't get paid till they sell a business. And ClearPath has worked a different compensation structure. It ends up in the same place, but it puts us in greater alignment with our clients so that we are not obsessed with selling fast. We're obsessed with doing the right thing. And sometimes, as mentioned, that means actually not selling.
Yeah.
If that's the right thing. So I think you got to look at your advisor and make sure they're aligned with you and what you're all about. And that would include some of this integration planning. I mean, a Main Street broker is not going to get into that. They probably don't even know how. We know how because we've been CFOs. We've been business owners. We know what it's like to be in the seat of the actual operator of a business. We're not just theorists. That's a big variable. And a lot of brokers aren't.
That's very true.
Well, Chris, thank you so much for, sharing your journey and your insights. Of course, Pat and I have lived a lot of it, but kind of getting to reflect on it is fun, but also always very engaging just to remember the history of ClearPath and where we are today. Before we go, do you have any final thoughts or advice for our listeners who might be thinking about the future of their business?
Well, I'd say we've covered a lot of ground. I think that one of the things we mentioned was don't try and do all this yourself. You don't have to engage ClearPath, but exploring the possibility of selling your company, or the way we frame it, creating a healthy sellable business, whether you plan to sell or not, is such a big thing that to try and do that by yourself, unless you have that kind of expertise, but even then, I would say to Kristianna's point, if you're going to do that, you're going to take your eye off the business, or you're going to sacrifice somewhere. I would at least suggest that you engage with a firm like ClearPath or someone similar to explore how this might work. And one of the first things we would do if engaged that would be helpful whether you want to sell or not, because how do you even know necessarily, is we would go through and figure out what's your company worth, ballpark, and what would make it worth more, or what's getting in the way of a higher valuation. What can be changed or fixed or addressed if given focused attention on the part of yourself or your team? That's a no-lose scenario, and that kind of gives you the ability to explore some of the concepts of selling and what that might be like. Gives you a basic idea what the company value might be and why, and what might make it worth more. And then if you engage ClearPath in any way, then it also gives us a chance to work together and build a relationship and see if we can help you further. So I'd say, that's an easy first step, and it's the one ClearPath would prefer, because rarely do we want to just, in our history, in all those 185 transactions, almost never do we jump straight into an M&A transaction. It's happened, but we can do that. But most of the time, we start with a project, and we get to know each other, and we get to learn your business. Because, again, we can't do our best job helping you if we don't understand how you think and what you value. And if we don't get to know each other, that's not going to happen. And we want to do that. So project by project, each independent, each its own thing, no hooks, no requirements to hire us again. But if you do, it could ultimately lead to an M&A transaction if that was your goal. And then we'd be all the more prepared to do that and get you the best deal that you want. So that would be my advice. Start with project, typically evaluation, and just see where it goes from there. But I'd say for me, this is a dream come true to see ClearPath in your hands, you two guys in particular, and Patrick. Patrick's my age, and I know he's helping. His goal is to hand it to you too, and maybe you'll have another partner someday and position you to take it to the next level. So yeah, you can have an even bigger experience on the next go around, Kristianna. But for me to see you guys take over and be positioned to take ClearPath to the next level, it's a dream come true. I'm really happy to see you guys in that spot, and really thankful for our partnership all these years. You guys deserve it. It's been a great ride. I know it's not over yet.
No. Thank you, Chris. And now it's our turn to make our healthy, sellable business so that we get to be having this podcast with the next round of ClearPath owners.
Exactly.
But yeah, thank you again for joining us. And to our listeners, thanks for joining us on ClearPath's first Healthy Sellable Business podcast. Hopefully it's the first of very many, and we look forward to the next time. Don't forget to follow us or subscribe to stay up to date.